Hi, this is Leo Correa. In this video, we're going to explore the Main Street Lending Program. This is the follow-up program to the Paycheck Protection Program that gives companies the working capital to recover and reduce the risk to the bank. Hello everyone. In this video we're going to give you an overview of the Main Street Lending Program. Probably one of the most impactful programs to follow up the Paycheck Protection Program. First of all, the information in this video is updated through June 19th, 2020. Lender registration began on June 15th and the program is just beginning. It's very likely that there will be changes to this program as time goes on. The program is open until September 30th, 2020, and the Federal Reserve has the option to extend that date. Remember, this is an overview to understand the details of some of these sections and how this program can work for you. Contact us or see one of our other videos on the Main Street program to learn more. In our original videos relating to the Paycheck Protection Program, we divided the COVID-19 recovery process into 4 stages. And these were the shutdown stage, the startup stage, recovery, and normal operations. The PPP loans provided the disaster relief that was needed during the shutdown stage. Now that the restrictions are being released and businesses can start to get back to normal operations, we enter the startup stage. As we complete the startup stage, we start to work towards recovery. And a key component of the recovery stage is going to be refinancing. At first, there didn't seem to be many options for refinancing, and banks were hesitant to lend in an environment that created so much uncertainty. Now, the Main Street Lending Program has been created. There are many options for refinancing during the recovery period. The Main Street Program is focused on helping companies that were in sound financial condition prior to COVID-19, but as a result struggled through the pandemic and now need additional assistance beyond the PPP program. The Main Street Lending Program consists of 3 different components: the new loan facility, the priority loan facility, and the expanded loan facility. Our focus in this video will be on the new loan facility and the priority loan facility. And as you can see, these loans come with a standard 5-year term, principals deferred for 2 years, and interest payments are deferred for 1 year. And the interest rate, that interest rate will be capitalized. The interest rates will be based on LIBOR rate. The loan size begins at $250,000, and depending upon whether you're in the new loan facility or the priority loan facility, the maximum loan will be $35 to $50 million. The loan amounts are capped at 4 times or 6 times EBITDA. So let's look at the payment terms, because this is where there is a substantial savings in cash flow. For the first 12 months, there will be no payments at all. All interest will be capitalized into the balance of the loan. In the second 12 months, there will be interest-only payments. In the 3rd year, you'll be paying interest only with a 15% principal payment at the end of the 3rd year. The 4th year also is made up of interest-only payments with a 15% principal payment at the end of the 4th year. The 5th year contains interest-only payments with a 70% balloon payment at the end of the 5th year. Obviously, with this structure of a loan program, it's designed to give companies breathing room to recover from the COVID-19 pandemic by easing cash flow and providing financing. It is expected that the company will refinance and term out the balance sometime in years 3 through 5. Now let's take a look at an example so we can see the impact of the Main Street lending program is going to have on cash flow of a company. First, let's look at the cash flow associated with the Main Street lending program. Assuming a loan amount of $2 million and an interest rate of 3.5%. In the first year, as we said before, there will be no payments due, but the interest will be capitalized onto the loan balance. Year 2, there will be interest-only payments. Year 3, there will be interest-only payments with a principal payment of 15% of the total loan balance paid at the end of year 3. Year 4 will be the same as year 3, and year 5 will contain interest-only payments with a balloon payment of 70% at the end of year 5. With a traditional loan, principal and interest payments are paid equally throughout the 5-year time frame. This creates debt service in each of the 5 years, and as you can see, the annual debt service for the early years of the loan is reduced substantially, allowing the company to utilize its cash flow to recover from the pandemic. In addition to improving cash flow, the loan program will also have a substantial impact on the balance sheet because it will change and reduce the amount of current portion of term debt associated with this loan. In this example, you can see the Main Street lending program that there is very little current maturity of term debt in the early stages of the loan program, whereas a traditional loan will have substantial amount of current maturities, reducing current working capital. So this program helps not only by improving cash flow in the early years, but it is also reducing the stress on the company's current working capital at the time the loan is made. There is no doubt the Main Street lending program was specifically designed to create a financing opportunity for companies during the recovery period. The Main Street lending program has an interest rate that is variable and is 3 points above the LIBOR interest rate. To get an idea of what the LIBOR rate trends are, we have graphed the last 140 days of the LIBOR rate. The rate maxed out at 1.665% with an average of 0.8%, and the current rate as of June 12th is 1.195%. So as of June 12th, the Main Street lending rate would be 3.195%. To look at a longer term trend of the LIBOR rate, we've graphed the last 600 days of the LIBOR rate, dating back to October 21st, 2018. And as you can see, the rate has been trending down, but the maximum rate at this time for this period is 2.5%, which means that the maximum rate for the Main Street lending program in this time frame would have been 5.5%. Now let's take a look at the bank's risk in this transaction and how it works as an incentive to lend under the program compared to traditional lending programs. First, a borrower applies for a loan through its bank. The bank will fund this loan and then in turn request participation from the special purpose vehicle which was set up by the Federal Reserve Bank to participate in this loan. The special purpose vehicle buys 95% of the loan from the bank, and the final result is the bank will be at risk for only 5% of the total loan. So when we look at a loan of $2 million, the bank's risk exposure is only 5% or $100,000 of the total $2 million loan provided in this example. The calculation of the maximum loan amount is based on the company's 2019 EBITDA. In the example here, we're showing $500,000 of EBITDA under both the new lending program and the priority lending program. Because they use different multiples of either 4 or 6, the lending limit for this company would be either $2 million or $3 million, depending upon whether it applies to the new lending program or the priority lending program. The major differences between the new versus priority programs are in the terms of security interest and loan priority compared to other loans or debt instruments other than the mortgage debt. One frequently asked question is, can these loans be used to refinance existing debt? And the answer is yes. And that may be one of the key strategies associated with using some of these loans. To qualify for the loan, the company must have a pass credit rating under the current lender's risk rating system. Even if the company subsequently receives a downgraded rating because of COVID-19, the pass rating at December 31st, 2019 is the key qualifier for approval in this loan program. The requirements under the new lending facility for the Main Street program is that the new loan must not be at any time contractually subordinated in terms of priority to any other loan or debt instrument. This is a relatively easy requirement to achieve for the Main Street new lending program. In the Main Street Priority Lending Program, this loan must be senior to or pari passu with, in terms of priority and security, with other loan or debt instruments other than the mortgage debt. Pari passu simply means that it's on equal footing or an equal level to the other debt instruments in terms of priority and security. So to put this to use, we really got to create a strategy around the use of these loans, whichever one you choose. And to start with, we start with the stages, looking at the stages of the pandemic. Here we calculate the cash flow and the working capital and the impact of the different options. And we want to include the potential strategies of using the new program versus the priority program. And we also want to look at refinancing existing debt versus providing working capital. And we also need to measure the impact on the future balance sheets and income statements, really more so from a ratio standpoint. The Delta model helps define this strategy by looking at the balance sheet and looking at all the ratios going forward. It looks at the income statement going forward to understand all the ratios associated with that. We also look at all the financial ratios relevant to the lender in the process, so we can understand what they might view as stress in the situation. And we also look at the collateral in this situation. Now what we're going to do, just to give you an example, we do have a simulation tool which will calculate the benefits of using one program versus the other. It allows data entry into the highlighted cells, and we can see what the adjusted EBITDA is. We can look at the multiples of 4 or 6 under the programs and see where net cash availability is under the program. We detail the debt associated with this and the collateral of the assets. This makes it very easy to determine which loan program is right for the company. Thanks for watching. If you found this video helpful, please click the like button below, and if you want to see more videos like this, click the subscribe button. If you have questions or would like help executing these or any other business strategies, you can contact me directly at the email on the screen. Thanks, and have a great day.